several instances, management of an entity will undertake or present an expenditure in the financial statement without it having an obligation backing it. In other words, we have these practices by management where they will undertake or present an expenses or an expenditure in the financial statement just to reduce their profits without it having any obligation. This is referred to as big bath. In view of that, the International Accounting Standard Board have come together to establish a standard which will govern and prescribe how set expenses which don't have any practical or realistic transaction, how we should account for them. And this has been enshrined into the International Accounting Standard 37, that is provisions, contingent liabilities, and contingent assets. So basically, that is what we are going to look at in this particular lesson. IAS 37 was established to prevent management or accountants from undertaking or presenting any value of expenses in the financial statement, that is the P&L account, without it having any obligation or any legal or constructive obligation backing that particular expense that has been entered. Sometimes there will be a change of management. There will be a reconstruction or reorganization of an organization. So that means the new management will take over from the old ones. So when this new management take over from the old ones, they will present from the earlier stage of their account series of expenses, and they will attribute the fault to the old management. And then in a short period, they will come as a means of improving on their business, as a means of they telling end users that they are doing better. They will just change those expenses that they have actually attributed to the old management as what? As an income. And they will present this in the financial statement as a means of what? Income. This is basically known as the big bath. And this issue has been kept or has been helped by the introduction of IAS 37. IAS 37 is actually categorized under three headings, and they are different from one point to the other. So we have provisions, we have contingent liabilities, and we have contingent assets. These three are dependent on each other. So in this video, you take each of them and see how you will recognize them, how you will measure them, and how you will account for them in the books of an entity. Let's look at the scope of IAS 37. IAS 37 deals with provisions, contingent liabilities, and contingent assets. We will look at the definition of provisions, but there are some provisions that we already know, or some jurisdictions say that some provisions are there to reduce an asset. Example is provision for depreciation, provision for doubtful debt, and provision for other debts that we know. They are there to reduce an asset. Such provisions does not fall within the scope of IAS 37. And other provisions that are accounted for under any accounting standard does not fall under IAS 37. Basically, we are just looking at provisions, and we will look at what provision is under the standard IAS 37. Now, the objective of IAS 37 is to prescribe the appropriate recognition criteria and measurement basis for provisions, contingent liabilities, and contingent assets. That set appropriate criteria, set measurement basis will provide sufficient information that will be disclosed in the notes to a financial statement, which will aid end users' understanding when it comes to taking their decision. So basically, that is the objective of IAS 37, to prescribe the recognition criteria for provisions, contingent liabilities, and contingent assets, and also to provide sufficient information to end users when it comes to making their decision. Alright, so without wasting more time, let's take the first category of the standard, which is provisions. Now, when we say provisions, what are we talking about? We are saying that provisions are liability that are uncertain, or provisions are uncertain, they are liabilities with uncertain timing and amount. So basically, we are saying that they are liability or liabilities that is having uncertain timing and amount. So in a simple terms, we are saying that provisions are liabilities. They are liabilities, but these form of liabilities, we are uncertain about them. We are not certain, so we are uncertain about the timing. We are uncertain about the time they will be incurred. We are uncertain about the exact amount that we are going to write in the books of the entity. So basically, when we say provision, we are saying that they are liability, but this form of liability, we are actually uncertain about the time it will be incurred. We are again uncertain about the exact amount that we will present in the books of what? The entity. So basically, this standard tries to solve three questions. Should provisions be recognized in the books of an entity? How should we measure it? Or what amount should we present in the books of that entity? And what will be the double entry principle or the double entry for the initial measurement and subsequent measurement? And these issues are what the standard tries to resolve. So when we say that provisions, we are basically looking at a liability which is what? Having uncertain timing and uncertain amount. Then the question is, what is liability? You know, liability has been explained in the regulatory framework, and we know that liability is an obligation. In fact, not just an obligation, but a present obligation, which is arising as a result of past events. So remember that we are having a key term in the definition of provision. So we are looking at that key term under the provisions. So which is what? Liability. So we are looking at what is liability. We are saying that they are obligation. Please, not just obligation, but present obligation. Present obligation, which is resulting or which is as a result of what? Past events. The settlement thereof, which is what? Expected to result in an outflow of the entity's resources embodying economic benefits. That is liability. I'm taking it again. We are saying that it's a present obligation which results or which is as a result of what? Past event. This obligation the business is presently having because they have already undertaken a transaction in the past. So this obligation is present, but it's as a result of transaction which has been taken in the previous years or the previous accounting period of the entity. And if in case you want to settle these obligations, it must result in an outflow of the entity's resources, and those entities' resources should contain or should have economic benefit, which is what? Embodying economic benefit, because some resources lie in the business idle without having any economic benefit. So if you want to settle that liability, there should be an outflow of your resources embodying economic benefit. That is basically about what? Liability. Now we've also seen another key term, which is what? Obligation. So we are looking at the definition. Remember, anytime you take a standard, you have to look at the definition, the scope, the recognition, the measurement, and then how you should disclose it. So we are looking at the definition of key terms. Now let's take the obligation. Obligation, we are saying that they are events that creates two things. So obligations basically create two things. First, it creates legal or constructive obligation. So anytime we say obligation, we are saying that events that create what? Legal or constructive what? Obligation. And this obligation, the entity cannot avoid or cannot undertake any realistic alternative to the obligation. What it means is that once this obligation is placed on you as an entity, you don't have an alternative of, not discharging or terminating that obligation. You don't have any realistic alternative to that particular obligation. That is why we say it is a legal or constructive obligation. So basically, this is the definition of some of the things that we are going to use in the standard. All right. Now, having a fair knowledge about the things we are going to meet, having known what is provisions, what is a liability, and what is an obligation, we want to see the criteria that one or a business or entity is supposed to meet before we can recognize provision. Remember that our focus is still on provisions. You will come to contingent liabilities and contingent assets. So, what criteria is an entity or entity supposed to meet before they can recognize provisions in their books? We have three criteria outlined or enshrined by the standard IAS 37, and we are going to go through all of them. Remember that each criterion is supposed to be met before an entity can, recognize provisions in their book. What it means is that if all the three criteria are not met, or the entity does not meet all the three criteria, then we cannot recognize provisions in the book of the entity. So the first criteria is that there should be a present obligation as a result of what? Past events. So we are looking at the first criteria. And the first criteria, we are looking at present obligation. Remember that this present obligation should be as a result of past events. Assuming that we are in 2021, and then as an entity, we have entered into a contract, we bought something on credit in 2019. Let's say we have bought our raw materials that we use for production on credit basis, and we undertook that particular transaction in 2019, let's say $10,000. And we agree that we are going to pay this amount in 2022. This we have already incurred in 2019. In the books of 2021, we are going to present this value as a liability in the books. This has created an obligation on the entity that we are supposed to deliver a cash or an amount of resources at the end period or pertaining to the clause in the contract or in the agreement. We are going to deliver this amount, which is going to be an outflow from our economic resources. So simply, it's a present obligation to us. Currently, we are owing them, but this is happening as a result of a transaction that we have already incurred in 2019. So that is about obligation. And remember that obligation is either legal or constructive. You will look at what we say is legal and what we say is what is constructive. So this is the first criteria, and we are going deeper to know what is legal and what is constructive obligation before we come to the second criteria and then the third one. So when we say obligation, we are saying that it can be legal or constructive. Remember that this must be always a present obligation. So also present legal or present constructive obligation. I have explained what present obligation is. This is as a result of past events which has already, or past transaction the entity has already incurred. Now when we say legal, it's basically because we have entered into a contract or is backed by a law, then it's legal. Because we are entering into a contract, that makes it legal. And contract can be oral, it can be written, or it can be implied. Now when it comes to constructive, of which most of the questions you'll be meeting will probably be in legal terms because there will be a contract. But when it comes to a constructive obligation, we are basically looking at the practices of the company or the organization, the policies of the organization, the warranties that the organization has given, has made the surrounding environment that they are going towards. It has placed some expectation on the company to deliver that particular policy or that practice that what they have written. Right. So with a constructive obligation, basically we are saying that the practices of the company, the policies of the company, has made others to believe that, or has made others to expect with probability, with very high probability that they are going to deliver those practices or deliver those policies that they have written in the contract and the clauses. For example, maybe it is known by customers that after you've made sales to a customer, you provide after sales service for 1 month. It is known by everybody. That is your practice. Therefore, it is expected by the customer to provide your service after you have made sales to that particular customer. So it is your practice. So it has placed some kind of expectation on you as an organization. So failure to do that or failure to fulfill that practice plays some kind of you are going to incur some what we call provisions. I will look at that in the later of the video. But remember that constructive obligation is basically the practices, the policies of the company that has made others to believe or expect something from you as a company. So we are supposed to differentiate between legal and constructive obligation. That is the first criteria when you want to recognize provisions. Remember that the obligation is supposed to be present, and we are not supposed to look at future happenings as a result of past event, but not future events. Assuming that a company wants to undertake reorganization in the near future, management have agreed that they are going to reorganize the company in the near future. That is a future event. So this does not create any present obligation. So any expenses that will be incurred must not be accounted for, must not be an obligation, or must not be written in the books of the entity. This is what they were doing previously before the introduction of IAS 37. Assuming that we want to restructure our firm, the structure of the firm, we want to change the management. But this is a future happening, not a past happening. So therefore, it does not present any present obligation because it is not as a result of a past event. Remember also that an obligation must be known by the second party. You cannot have an obligation as an individual. Obligation, you enter into a contract with 2 or more parties. It's not necessarily that you know your party, because sometimes you'll be dealing with a group or an entity which is having the legal entity principle. So like I was saying, the obligation must always be involved 2 parties or 2 or more parties. And it does not necessarily mean that you should know the party involved. Now, one thing you must also note is that an event which is not communicated, a past event which is not communicated, does not create any form of present obligation. Assuming that you want to undertake restructure of the business, probably you incur some expenses because you are going to contract people to come and value your asset for you. Those expenses, in actual sense, are provisions, but you have made this plan, but it has not been communicated to anybody, any interest group. Then that particular plan does not create any present obligation. So remember that an event which is not communicated does not, even if it's past and it has not been communicated to the right people, the right stakeholders, it does not create any present obligation. So this is all the complications under the first criteria, which is present obligation. The second criteria that we are supposed to meet before we recognize provisions is that it must be probable. It must be probable that there will be an outflow of economic benefit from the entity or from the resources, an outflow of the resources embodying economic benefit from the entity. So the second criteria is what? Probability. So they must be what? Probable of an outflow of economic benefit. What this simply means? Probable simply means it is more likely than not to occur. So more likely than not to occur. More likely than not to occur. What it means is that when there is an provision, there should be 50% and above probability that that provision is actually going to be incurred before it can be recognized as a provision. Anytime a provision does not meet this particular criteria or this particular one, then it leads to something else which we will discuss later. That is contingent liability, because that is leading to a possible obligation but not a probable obligation. So remember that when it's not probable that there will be an outflow of economic benefits, it's not probable. You don't know. It's not 50% and above probable that there will be an outflow of economic benefit. Then we cannot recognize a provision, but you have to recognize another form of what? A liability, which is what? A contingent liability. And then the last criteria is that there must be a reliable estimate. So here we are looking at reliable estimate. Reliable estimate can be made of the amount of obligation. Now you know that there is a present obligation because of past events. We can be sure with 50% and above probability that there will be an outflow of economic benefit. But what amount should we present in the books of account as that particular provision? That is the third criteria. There should be a reliable estimate. We should be able to make a reliable estimate of the amount on the obligation. That is basically about what? Measurement. And according to IAS 37, there is some few things you are supposed to know when it comes to the measurement of our provisions. So I'm going to take you through them. The first one is that a measurement of provision should be the best estimate. So a measurement of provision should always be the best estimate. Should always be the best estimate. What it means is that sometimes you'll be presented with a question with different figures. So assuming that there is a lawsuit against a particular company, and if they settle the lawsuit within this frame, this is the amount that they are going to incur, maybe $2,000. And then maybe in the next period it's going to be $3,000. Maybe in the next period it's going to be $4,000. With this, if you want to measure the provisions, the amount to present in the books, we consider the three figures and we take the best estimate. Taking the best estimate always depends on the provisions in the question. The question will always guide you as to which of them is the best, estimate. The best estimate does not always necessarily mean to be the lowest or the highest. It depends on the conditions that is presented in the question. Another thing you are supposed to note under the reliable estimate is that when we are dealing with just one event, then we are looking at a price that you use, which was what? The most likely outcome. Most likely outcome. In the case where we are dealing with just one event, then the value that we will use should be what? The most likely outcome. What it means is that, again, assuming that there's a lawsuit, and then the expenses that we incur is 3, the number. It's just one event. If it's just one event, then in this case, we can consider this to be what? The most likely outcome, because the first event can end or terminate everything. So in this case, the 2,000 becomes the most likely outcome. In a situation where we are having more than one event, then the most likely outcome ceases to be relevant. Then we have to go for what we call expected value. So when the events are more than one, then we go for expected value. In this case, there are more than one event, so that means two or more events in the what? In the question. We are supposed to calculate for the provisions of all of them and we sum them up. That will be what? The expected value. So you are supposed to differentiate them when it comes to what? The third criterion. That is the third one, which is what? The reliable estimate. As to how or the value you should place on what? Your provisions. So please remember that these three criteria are all supposed to be met before one can recognize and present the provisions in the book of the entity.